Equity, bond, commodity, and currency markets are still trying to work out exactly what President Trump's tariffs are and what the strategy is. And in the coming week, we may start to get a little insight from what companies think of it all. It could still be too early to tell, and some may decide to just keep their heads down rather than give any forecast which can be used against them in future. But it may be worth keeping an eye on the scheduled results or trading statements from the following FTSE 100 index members in the week ahead. JD Sports on Monday the 21st of April, Bunzl, Croda, Fresnillo on the 23rd, Relics, Unilever, Hikma and Anglo American on the 24th, and WPP to round out the week on Friday the 25th. But even that list may pale next to the dazzling array of statements due on the other side of the Atlantic, where the first quarter results season will hit top gear. And for all that, we will get results from IBM, Texas Instruments, Boeing, Procter & Gamble and PepsiCo to name but 5. Top billing is likely to go to 2 of the so-called Magnificent 7. Tesla reports on Tuesday the 22nd of April and Amazon.com on Thursday the 24th. The Mag 7 haven't been immune to the wider market upset. They've lost nearly $4 trillion of stock market capitalization between them since their aggregate valuation peaked at $18.5 trillion on December the 24th. So that's a drop of a fifth. It still means their combined worth is 5% above where it was a year ago, so it's still probably too early to talk about a real loss of faith in them, even if gold is up by a third in the past 12 months to hint at some kind of change in the market mood music. But any shift in sentiment toward this septet could still have wide-ranging implications, though, given how they represent almost one-third of the total stock market valuation of the S&P 500. Tesla's now the smallest of the Mag 7 in terms of its stock market value at just over $800 billion as I record this, and that's after a sharp fall of almost a half from the December high. Bulls will note the shares are still up by nearly 50% over the past year. Bears will growl they're almost unchanged over the past 4 years. The battle lines between believers and skeptics are still drawn, and these first quarter results will help to shape the debate. Tesla's already released a pretty weak set of first quarter delivery and production numbers, though it must be said, and they showed a 13% drop in shipments, the lowest level since the second quarter of 2022, and a 16% year-on-year drop in output. The retooling of factories for the latest version of the Model Y may have been a factor here, but that was the third time in 5 quarters that both deliveries and output fell year-on-year. This could be down to a slowdown in the wider electric vehicle market, stiffer competition from the likes of China's BYD, and maybe, just maybe, some customer pushback against Mr. Elon Musk owing to his association with the Trump administration. Either way, the much-vaunted Cybertruck and Cybertaxi are yet to really move the dial, and nor autonomous driving, but supporters will assert that both are about to do so. In terms of the headline numbers for the first quarter, analysts expect sales of $21.9 billion and earnings per share of 45 cents. That implies sales at 3% and flat earnings on an adjusted basis. Tesla's not really in the habit of giving guidance, but for the second quarter, analysts are looking for broadly flat sales at $25.2 billion and a 10% year-on-year increase in earnings per share to 58 cents. Analysts will dig into the divisional trends across auto sales, auto leasing and energy, and one wrinkle to watch here may be how many regulatory carbon credits Tesla sells in the quarter. The European Union's easing of its requirement for car makers' EV electric vehicle volumes and the fines they must pay if they don't make their target mean that those auto firms may need to buy fewer credits to the detriment of high-margin revenue streams for Tesla. More strategically, analysts and shareholders will want to know about the possible impact of tariffs upon Tesla's business, given how the firm imports around 70% of the parts it needs for its US factories, even if it assembles the vehicles there. Now, Amazon.com's boss Andy Jassy is also likely to get questions about tariffs, given the importance of its supply lines from China and elsewhere, especially for the retail business. The US retail operation made a 6.4% operating margin in 2024, and the international one scraped a 2.6% return on sales, as AWS, the cloud and data storage server operation, made a 37% profit margin and generated nearly 2/3 of group operating income. In terms of the headline numbers, analysts are looking for an 8% jump in sales to $155 billion in the first 3 months of the year, and a 1/3 advance in earnings per share to $1.37. Like Tesla, Amazon.com doesn't really give much away by way of guidance, but for the second quarter, the current consensus forecasts expect a 9% increase in sales to $161 billion and an 8% year-on-year increase in earnings per share to $1.39. Other than that, be lovely to hear from Mr. Jassy, who's the choice to play the next James Bond. However, on that note, I hope that you and your families are all keeping well. Thank you for watching, and I look forward to seeing you again next time.